Good morning, everyone. Bill Ulivari here with Cenacle Capital Management. Good morning. Happy April Fool's Day. Today we're going to do a Q1, the first quarter of 2022, a quick look at how the stock market and commodity market has performed. We are going to share our screen with you, so please be patient with us as I click this button over here. And what we're going to do is just go over some of the returns year to date for various commodities and exchange traded funds. So please excuse me while I put my cheaters on here. We have lumber down 15.91% year to date. Growth as an asset class, which is like one of those exchange traded funds. It's the technology side, the communication side, telecommunications, internet. The technology side of the market is down 12.83%. And which is interesting is if you scroll down here to RPV, all the way down here, which is up 5.96%, the stuff that we owned for the last 18 months, and especially this year to date, is up 6. The stuff we're just buying now is down almost 13%. So I believe we're going to see a flippening, a trade, a pendulum going back to the middle of the clock, where value is going to sell off and growth is going to increase. And I'll get into that in just a chart a little bit later. But we see interest rates in the very long end of the range, long-term bonds down about 11%. The Bitcoin Investment Trust down 10.96%. But this is about 30% under net asset value, which I find really interesting. So we own Bitcoin in virtually every single one of our accounts, and it's trading below parity. It's trading at a huge discount to cash, and which makes this a very exciting trade, in my opinion, a very good position. And again, we only have like a 3 to 5% position in Bitcoin for most of the accounts. So don't be afraid. Even if Bitcoin were to decline more, or we see that discount below the cash price trading, even at a greater discount, it still only represents about a 3 or 5% position in the portfolios. Technology is in the QQQ and Nasdaq down 8.5, down about 8.5%. Excuse me. The small company index, the Russell 2000, again mostly growth stocks, down 6.5. S&P 500 down 4.95% year to date. The FXC, which is the Eurodollar Trust, down 3. Now, this is an interesting This is another interesting paradox here: is that the Eurodollar is down 3, but the U.S. dollar is up 2.6, and we're long the U.S. dollar UUP in our account. So we're going to be selling that and buying the Eurodollar because I think the U.S. dollar has just about rallied far enough. It's up again about 3% year to date. It's up huge since its lows in 2019, and so we want to make sure that we sell the things that are, maybe have gone their cycle, and buy the things that are oversold and look like a really good value. So we're going to be doing that again this year. And if we want to look at the things that are up on the year, we have interest rates up 53% year to date. This means that the 10-year U.S. Treasury, the risk-free rate is at 2.3%. It probably was, 1.6% or so year to date, coming into the year. So we've seen a definite increase in interest rates this year. Natural gas, which we own via the exchange traded fund UNL, is up 51%. That's one of our best trades. XME, the metal and mining ETF, up 36%, almost 37. Again, one of our better trades. I'm not a huge gold fan, to be honest with you, or silver, but silver and gold are up about 6% year to date. And again, I still think that the thing that's really staring me in the face is this huge spread between value and growth as an asset class. Value is generally considered defensive, value is considered defensive where growth is considered aggressive. Risk on is growth, risk off is value. And look at this trade here. This red line represents growth funds. This line represents value funds. And you can see going back all the way to 2016, nope, maybe 2010, 2012. We actually have to go all the way back to 2009, the Great Recession low, to see growth so unwanted, so just, people just don't want to own growth. And again, this was right before the great bull market after 2009 into 2012 and beyond. So I think there's something really interesting going on here, and that's why we're selling value and we're buying growth, because I think we're going to see this same thing happen again. I think we're going to see growth in technology and communications outperform the dividend-paying stocks and the what we like to call the widow and orphan kind of funds value. And as far as sectors are concerned, again, no surprise that energy is at the top of the list. I'm kind of surprised to see technology as high as it is. But what we're seeing on the bottom end of the scale is utilities and in the industrial and healthcare sector. So healthcare has not done well. Energy has done remarkably well and has traded better than the S&P 500. So again, this really interesting disparity. And so we're probably going to be selling our XME and our metals and our value components and buying the things that are really oversold, like communications. Not so much the industrial side. I don't think that that's the place to put our money, but some consumer staples, things that are the necessary items to buy. So people have flocked to discretionary, which are the luxury items, and the things that are staples, like food and hygiene, those have sold off really well because those are considered value propositions. So again, we're seeing this shift between value and growth, and we want to make sure that we take advantage of that. So that's really it for this quick video. I wanted to touch base again on how the market has done the year to date and what we plan on seeing going forward. Again, I think we're going to see growth do well and value, which is defensive, not do as well. So in other words, what I believe we're going to see is risk is going to come back onto the market, and people that played it too defensive are going to potentially get hurt, I think. We're also talking about the Ukraine-Russian war. We have the equivalent of the Russian Dow Jones Industrial Average up roughly 58% from its lows made on March 24th. So I don't think the Russian-Ukraine crisis, although it's still an issue, I don't think it's going to really affect the markets going forward. We're seeing in the markets actually strength moving back to Eastern Europe. And we actually bought some Eastern European funds for just a few accounts as a test, a kind of toe dip. And those are up probably 40% since we bought them like a week ago, which is insane to me. But anyhow, thanks for joining us, Bill Ulivari. If you have any questions, comments, concerns to your portfolio, don't hesitate to contact us. And have a great April Fool's Day and a great Q2.